Disney out with its quarterly report card after the bell. The stock under some pressure after the company reported a miss on second quarter earnings. And revenue, though, was in line with estimates. Joining us now to discuss, along with a broader look at the entertainment and streaming industry, is Third Bridge Group sector analyst Jamie Lumley. Let's get right into it. Jamie, what did you take away from today's earnings from Disney?
Thanks so much for having me today. I think there are a number of things to look at as we start to really read through Disney's earnings from today. First off is looking at subscriber growth. We've already heard not promises, but a change in focus at Disney from looking at the subscriber numbers to really starting to rein in costs, but at the same time, seeing overall subscribers drop across Disney Plus internationally is really one of the big things to look at here. However, on the flip side of that, there is a fact that those losses are starting to be reined in. And this is one of the things that we hear very frequently from our experts is just how much of a priority it is for Bob Iger to really trim those costs. And seeing them, pared down by another couple $100 million, that is moving in the right direction. That being said, there's still a ways to go. And as if we look across this industry, Warner Brothers Discovery reported last week, starting to see some profits in their streaming business. It just starts to really dial up the pressure to understand, okay, when is streaming going to be profitable and when is Disney going to be able to round that corner? One last area definitely worth highlighting, looking at the parks. Growth continues to rebound there, seeing double digits growth based off of or compared with the year ago quarter. So definitely some areas to be encouraged for Disney right now.
Disney is in the midst of a reorganization. Three-pronged is how the company has described it, talking specifically about entertainment, ESPN, Disney Parks, and entertainment. If you look at the numbers today, and I realize this was just announced a few months ago, to what extent is Bob Iger steering in the right direction? In other words, are we likely to see any additional shakeups and potential cuts?
It's definitely a good question. And I think we should look back at the goals which Iger outlined during the last call, looking at $5.5 billion of overall cost reductions. $3 billion of that is through content, but then there's, of course, that other part which does come along the lines of restructuring the company, seeing what the right staffing levels are, and really trying to get things up and running for a couple of their businesses, which are loss leaders, mainly streaming right there. Certainly, we're not that far along when it comes to the amount of time which has passed since those changes are being made. But depending on really just how long that timeline is, that is one of those big things, which I'm sure Iger is thinking about very frequently as he proceeds with this year running the company. One of the things we definitely hear from our experts is that Disney is in a period of transition. And as it looks to round the bend for streaming losses and drive growth across all the different businesses, I'm sure they're definitely feeling some pressure when it comes to really seeing a delivery of results and paring those losses. So are there going to be more restructures to come? I'm sure that there are a lot of people would hope not, but at the same time, cutting those costs down is a top priority, and Iger will definitely be finding the right way to go about that.
Specifically on streaming, to what extent does the current writer's strike complicate the direction Disney's trying to take things in? We've already heard about production shutdowns on Marvel's Blade. There's also the latest Star Wars series that's been shut down. We still don't know how long this is going to take. What does it mean for the content side of the business?
It's a fair point. And one of the things that I think we've seen is that, of course, the first thing which is impacted immediately are those shows which come out on a weekly basis. And then longer term, this is more going to affect the content slated for years to come. So right now, when it comes to Disney's content priorities, while they have had to press pause on a couple of projects, this will not be impacting their content releases in the coming months. This is more of something which will probably be a 2024 impact, especially if the writer's strike is prolonged. We can already see, based off of highlighting again Warner Brothers Discovery, that for them, this is more for some of their immediate shows, not necessarily releases down the road. Disney is probably thinking about this in a similar way of the longer this goes on, the more those challenges will mount. But at the same time, depending on the timeline this is resolved, it could have less of an impact for the out part of this year.
Jamie, one of the things I'm seeing coming out of the earnings, notes saying that Disney going to be combining Hulu and Disney Plus into one streaming app. So what does that say to you about where Disney stands with regard to its investment in Hulu?
That's a very interesting point. So there are a couple things to pull out here. First is just looking overall at Disney's strategy. We've been hearing for a long time from our experts that it really has been challenging having Disney Plus and Hulu be separate, just from a branding perspective, from a marketing perspective. There are definitely some challenges to having multiple platforms with different focal points, different audiences that's trying to reach, whereas if there's one collective platform, it makes a number of things easier. And particularly for Disney, as it's looking to trim its streaming losses, having everything under one banner will make things easier. At the same time, if we look towards the deadline that Disney is facing next year to exercise its option to buy Hulu outright from Comcast, things are still a little bit complicated there. Certainly, if we look and see that these are coming under one platform, then that could be a sign that things may be shifting when it comes to Disney's leadership's priorities. But at the same time, they are cost conscious, and Hulu has been a successful platform. It'll be a multi-billion-dollar buying opportunity next year if it is looking to make that acquisition. It's a very large price tag. So those are a couple of factors which I'm sure for the outset of this year will continue to be top of mind for Disney.
And we'll be listening for any additional hints on the future of streaming for Disney in that earnings call. Jamie Lumley, Third Bridge Group sector analyst. Good to talk to you today.